this strategy here is the TMT bullet strategy. It is taken a little bit from the ICT silver bullet, but it's a different variation of that we have developed, and it's been working really well for us on the chart. So I'm going to run through this pretty fast. Yeah. So step one of this strategy, your pre-market prep. So all of the times here are New York time. So at 9:30 New York time, we're going to mark out with Asian range and with London range. So that's like 8 p.m. till 12, 3 till 5, the London range. And what I mean by range is you see this rectangle here, you've got your high and you've got your low. So you mark out the whole range, where the high is, where the low is, and where the time ends. So you can see it like clear as day on the charts. You do the exact same for the London range as well. So that's step one, 9:30 in the morning. You'd mark out those two ranges and then you move on to step two. So step two is you're looking for a liquidity sweep. So that is either the high or the low of either the Asian or the London session is being taken out. That's literally all you're looking for. So if it's basically by taken out, it just means has it went above the high of the session or has it went below the high of below the low of the session. Sorry, and it's taking the liquidity from the high or the low from the last session. So step three, in the execution zone, which I'll be telling the zones after in the next slide. So there's an execution zone, which is like 1 hour, two 1 hour slots throughout the day. And what we're looking for in this zone is a fair value gap and it to retrace into the fair value gap for us to then place a trade. So if that is not applicable, then we do not have a trade. So if there's no high or lows being taken out, we also don't have a trade. So if there's no liquidity sweep, the high and the low is not being taken out, we'll move on. Next day, we'll have a look and we'll go again tomorrow. You try a different, you move on to a different strategy. You've got this strategy is only when it literally hits these rules. But if a high or low has been taken out, we now look for a fair value gap within the execution zone. So if the high's been taken out, we're looking for a bearish fair value gap in the execution zone so that literally the liquidity is being taken at the top and it comes back down a bearish fair value gap, retraces into the fair value gap, and then we're looking for it to come down. If the low is being taken out, we're looking for a bullish fair value gap in the execution zone, looking for it to retrace back into that zone, into the fair value gap, and then go up from there. So there's the two things we're looking for in the execution zone. So execution zone and when to trade. So once again, New York time. The two zones, as you can see marked out here, is 10 a.m. at 11 a.m. and 2 p.m. to 3 p.m. And we trade this on the 5-minute time frame. So when to trade. If a high's been, like I was just saying before, if a high's been swept since midnight and a bearish fair value gap forms in the execution zone and is revisited, and by revisited I literally just mean if the candle wicks back into that fair value gap, we're then looking to place a trade. So in this case, if a high's been taken out and we're in the execution zone, there's a bearish fair value gap, it wicks back in, we're looking for a sell. Or on the other hand, if a low's been taken out and a bullish fair value gap presents itself within the execution zone, it wicks back into the fair value gap, we're looking for a buy right there. And that's pretty much as simple as that. In terms of the rules and the risk to reward, I'll show you on the charts like in literally 2 seconds after this. But what we're doing is all of the trades are a 1 to 2 risk to reward. And you enter as soon, like I just said, it wicks into the fair value gap. That is when you enter. And your stop loss is it the highest wick of the fair value gap or the lowest if bullish. So I'll show you. It'll be easier to show in a second. But you literally just put your stop loss to the top of the wick of the first candle of the fair value gap, and then you just do a 1 to 2 from there, and that's it. It's a mechanical strategy, so you can pretty much just set it and then that's it, leave it. But if you do want to manage your trade a little bit more and you want to see it in profit, it's absolutely fine to just set your stop loss to entry or stop loss into profit and leave it there. So it's a risk-free trade. But in terms of the risk to reward, it's always a 1 to 2. So what I'm going to do now is I'm going to come off here. I'm going to go on the chart. So we've got an example here. So as you can see, I've marked out the Asian range. So it goes from 8 till midnight, and you can see the high there and the lows there. So that's the lowest point of the Asian range, and that's the highest point. We've got the London range here. So we've got 3 till 5, and we've got the highest point there and the lowest point there, as you can see. So what we're going to do now, so this line is the midnight, so we're looking for a range to be taken out after midnight. And we've got here marked out with the black dots. That's the first execution zone. So we've got 10 to 11. So what I'm going to do is I'm going to play this now, and we're going to see if we can catch a fair value gap in the execution zone. So that looks like a fair value gap to me. 1 second. Yeah, so obviously if this is on the 5-minute time frame, we would have seen this forming. What we're going to do is we're going to mark this out here. Boom. Let's zoom in a little bit so it's a little bit more accurate. So yeah, see here, we're going to mark it out there. As you can see, we've wicked back in. So we've got the fair value gap here. We've wicked back in. So we're now looking, as you can see, sorry, I didn't really mention the liquidity. So as you can see, this is the high, and this is the high in the London session. So both highs have clearly been taken out. Yeah. So literally, the highs have been taken out. So now we've got to trade on if we can get a bearish fair value gap in the execution zone. So we're going to come here and we're going to see there's a bearish fair value gap in the execution zone. So now we're looking to place a trade. So the next thing we're looking for is, does it wick back in? Which, as you can see here, it's wicked straight back into the fair value gap. So what we would do here is we're going to place a short as soon as it wicks in from there. And then what I'm saying about the stop loss is, so the fair value gap is this candle, and this candle. So candle number 1, candle number 2, and candle number 3. So we're putting the stop loss at the top of candle number 1. So that's where the stop loss is. The top of candle number 1. And then we can see we've got a 1.7 here. So the risk to reward, we're just going to put it as a 2 right there. So we've got stop loss there, we've got a 2 risk to reward, and we're just going to play the trade. We'll place this right now. Boom, straight away we would have hit TP in the execution zone. Sometimes it lasts longer throughout, but that would have been placed it there. So 5 minute, 10 minutes, 15. Within 15 minutes we've hit TP on a 1 to 2 risk to reward. And that is pretty much the strategy. If you didn't get a trade in there, you could come along and we'll mark this. This is the second session that you can trade in. 1 second. So we've got this session also, which is 2 till 3. So we'd mark both of them out. So you potentially could get another trade in there, or if you didn't get a trade in here and it's obviously taking the high out. If a bearish fair value gap forms in here and it revisits it, we would have had a sell on from the next one. So kind of how this works is, I quite like it. You don't need to be in the charts all day. You can jump on at about 9:30 New York time. You mark out your 2 ranges. You've got your Asian range, you've got your London range. Right now you're looking, has a high or a low been taken out? Right, okay, well, we've had a high here taken out clearly. So now we're sitting this time. So we've got 10 to 11. We're sat and we'll go, right, is there a fair value gap formed? Right, fair value gap here, I'll place trade. If there's not, okay, I can do whatever I'm doing. Now I'll have a little look just before. I might come on at half 1 New York time. And I'll look, right, there's still the high's still here. It's and we're going to look. And right, there's a bearish fair value gap, we'll place trade. So you can kind of be on the charts like 2.5 hours a day, if that, and still be placing trades and being profitable. The risk to reward always 1 to 2, so that's, you're pretty much always set with your risk to reward. It's mechanical in that regard, which is good because that's how you kind of stay profitable. Where like your wins and your loss, like your wins are always bigger than your losses. So you can even if this strategy was profitable, had a 50% win rate, you would still be profitable, which is good. That's what you want. You want to be profitable. Other than that, I think what I would recommend if you're looking at this and you kind of want to try it is go back. This is what I done when I first started it. Is go back and back test. So if you've got TradingView, you just go on, you click the replay bar, you come here, pick a random day from months ago, and just come on, play it forward, look, be like, right, half line, I'm going to mark out the Asian range, the London range, has a higher or low being taken out. I'm going to mark out the execution zone. In execution zone, what am I looking for? Is it a bearish or bullish fair value gap? Has it presented itself? Would I place a trade here? And then get a Google Sheets or something like that and mark out your trades of what you would do. So pretend you've started with £1,000. Say, mark out your trade, right, won that one, hit stop loss, won that one, mark out your win rate, and then you could work out from there. If you started with £1,000 account, you could kind of look out at some of the trades and look at, like, mark it out on a pip calculator, and you could see, right, I'm happy to risk 10%, say, I'm happy to risk 5%, whatever you would be risking, and realistically mark it out, right, I would have traded this many lots, my stop loss would have been this, I would have lost this, all right, I would have won this, and you can actually work out how profitable you would be. If you're doing that for 20, 30, 40 trades and you're actually profitable with it, then you can start look to go get funded or trading it on your live account, and then you've got a profitable strategy. Pretty simple strategy, and I can tell you firsthand it works effectively on the chart. So yeah, if you've got any questions on it or anything like that, don't hesitate to pop a message